Organizations worldwide watch 5% of their annual revenue go right out the window due to a single cause: fraud. That is one of the findings reported in the Association of Certified Fraud Examiners (ACFE) 2020 report to the nations, a global study on occupational fraud and abuse. Accounting fraud is defined as fraud that involves theft and other crimes committed by accountants or related to an organization's accounting methods and practices. Welcome back to another episode of Facultive Station. Get involved and join the community by subscribing to the channel so you never miss any of our latest uploads. In this episode, we're going to be taking a look at the biggest fraud scandals in the financial world. Let's get to it. Enron. The Enron scandal is probably the most famous of Wall Street's financial scandals. Enron was a high-flying energy service company and a darling of the stock market in the last 1990s. When it eventually collapsed, shareholders lost as much as $74 billion. The CEO, Jeff Skilling, and the CFO, Andrew Fastow, used an array of dubious accounting practices to inflate revenue and hide debts. The result was that the company appeared to be the most profitable company in history, when, in fact, it was saddled with debt. The appearance of a healthy balance sheet and large revenues allowed Enron to easily raise more capital to keep the charade going. Most of the fraud was committed between 1998 and 2001, resulting in the stock price trading as high as $90.56. During this period, CEO Ken Lay gave Skilling more and more authority, which Skilling used to manipulate the company's accounts. The company was able to exaggerate asset values and revenue by changing an accounting policy to use market-to-market prices. These prices were then manipulated. Billions of dollars in debt were also moved from the balance sheet and hidden in shell companies in the Cayman Islands. The fraud accelerated when Skilling took over the CEO position from Lay. In 2001, the fraud became unsustainable and the company collapsed. Ken Lay, Jeff Skilling, Andrew Fastow, and others were arrested. Fastow and Skilling served 6 and 12 years in prison, respectively. Ken Lay died before he was sentenced. The scandal didn't only lead to the collapse of Enron, but to the demise of Arthur Andersen, Enron's auditor. The auditor overlooked the financial fraud and helped with the cover-up. Arthur Andersen's role in fraud remains one of the biggest accounting scandals in the United States to date. Worldcom. During the 1990s, Worldcom was the second largest telecommunications company in the U.S. However, in 2002, the company collapsed after wide-ranging accounting fraud was uncovered. Telecom companies performed very well during the 1990s as the use of mobile phones grew. When the industry later came under pressure, Worldcom executives turned to cooking the books. They inflated revenue and listed expenses as investments to create the impression that the company was still profitable and growing. Investors believed the stock was still a good investment, and so, at its peak, the company was valued at $180 billion. At the time, this meant it was one of the most valuable companies in the world. When auditors discovered that revenues and profits had been overstated by as much as $7 billion, the stock price quickly collapsed from $60 to $1, and thousands of employees lost their jobs. The company filed for bankruptcy protection and later emerged as MCI, a much smaller, restructured company. MCI was later bought by Verizon Communications. In 2006, Worldcom CEO Bernard Edwards was sentenced to 25 years in prison. He was released earlier this year after serving 15 years and died shortly thereafter. The Worldcom scandal remains one of the world's largest corporate scandals and resulted in nearly $180 billion in losses for investors and thousands of lost jobs. Mississippi Bubble. One of the first documented financial scandals was the Mississippi Bubble. It was also one of the strangest stories in the history of finance, involving an eccentric Scottish economist, the French economy, and one of the first banks to issue paper currency. For some reason, the Duke of Orleans, who was acting as regent in France, appointed John Law, a fugitive from England, as de facto Minister of Finance. France's economy was crippled by debt, and Law was given the authority to try to fix it. One of the solutions he pursued was setting up government-controlled monopolies to generate revenue for the state. Another was setting up a new bank that issued paper currency, still a novelty at the time. One of the monopolies that law established was the Mississippi Company, which would consolidate the trading companies in Louisiana into one entity. Law was allowed to issue 50,000 shares, but investors only needed to put down a deposit equal to 15% of the share price. Investors flocked to buy shares, and Law was able to issue another 300,000 shares. Within months, the share price rose from 500 to 10,000 livres. Law raised so much money that he was able to lend the French government enough to pay off the national debt. The problem was that so much cash was required for investors to buy the shares that Law's bank had to print more money. When Law realized that both the currency and the share price were inflated, he tried to devalue both in a controlled manner. Unfortunately, this resulted in a selling frenzy, with investors trying to sell their shares and then exchange the currency for gold. In the end, the company collapsed, and both the shares and France's currency became worthless. Widespread unrest followed, and Law, who had already been sacked, had to flee Paris and go into hiding. Charles Ponzi's Ponzi scheme. Charles' Ponzi scheme was by no means the biggest of financial scandals, and it wasn't even the first. In fact, Ponzi had a reputation as a con artist long before the scheme that made him famous. But it's worth mentioning because it was such a big story at the time that certain types of pyramid schemes are now known as Ponzi schemes. In 1919, Ponzi came up with a plan to trade international reply coupons, IRCs. These are coupons that can be exchanged for postage stamps. He believed there was an opportunity to buy discounted IRCs in Europe and then exchange them at face value in the United States. He raised money from investors, promising a 100% return within 90 days. The scheme quickly gained traction and he was easily able to raise more capital. At one point, he was attracting as much as $1 million a day. In reality, though, the scheme very quickly became too big to be feasible. But Ponzi found that he could easily pay the promised returns to investors from new investors, and that most reinvested the money in the scheme anyway. In fact, he had so much money flowing into the scheme that he could live an extravagant lifestyle. But the scheme collapsed within a year when a series of articles in the Boston Post caused investors to demand their money back. Ponzi ended up serving time in prison, but amazingly launched another scam as soon as he was released. Ponzi schemes and pyramid schemes are illegal in most countries. They are similar in that both pays returns to investors using capital from new investors, and both are unsustainable. The difference is that a Ponzi scheme has one central operator recruiting investors, while a pyramid scheme encourages each investor to recruit new investors. With that, we've reached the end of today's episode all about the biggest fraud scandals in the financial world. Which fraud scandal surprised you the most? Get involved and let us know in the comments section down below. If you enjoyed this video, remember to leave a thumbs up. Plus, if you want to see more fantastic finance and accounting content just like this, remember to subscribe to the channel and check out our other socials such as Instagram and TikTok that are listed in the video description. As always, thanks for stopping by and watching. See you again soon in the next one.